In today's turbulent market, all eyes are on Bitcoin and the upcoming US elections.
Exactly. With predictions suggesting that Bitcoin could skyrocket if Trump wins, this is a discussion you won't want to miss.
And let's not overlook the alarming drop in consumer savings. It's now down to just 2.9%.
We'll dive into these critical trends, along with essential warnings from yield curve inversions that hint at a looming recession.
Welcome to Financial Insights in Minutes, where we bring you the most important financial news quickly.
Let's jump straight into today's episodes as we analyze each of these crucial topics for you.
Buckle up, because we're diving into yield curve inversions, historically a strong signal that often precedes economic downturns. Today, we'll explore how recent shifts may indicate deeper market challenges.
That's right, the movements of the yield curve are significant. These changes frequently forecast economic conditions that can shake even the most experienced investors.
What's the broader picture here?
The central thesis revolves around the uninversion of the yield curve, which typically signals upcoming recessions. This isn't merely a casual shift. Historically, each instance has been linked to severe economic impacts, even the Great Depression.
What's the historical significance of yield curve inversions?
Inversions have long been a concern. For example, the yield curve transitioned from negative to positive just before the 2008 financial crisis and back in 1929, right before the Great Depression.
What's the situation in today's market?
Currently, the yield curve is steepening as unemployment increases, reminiscent of past market corrections. Historically, such steepening trends have often led to substantial stock drops.
How do whipsaw signals factor in?
Whipsaw signals can introduce confusion, misleading investors. While past whipsaw signals have sometimes led to significant rallies, they also indicate market instability.
What triggers past recessions?
Each recession has had a specific catalyst, whether it was the tech bubble or the housing crisis. Although the economy appears ready for a downturn, we currently lack a clear trigger.
What risks do longer yield curve inversions pose?
Extended inversions typically result in larger market corrections. Given current trends, the risk of a serious market decline is very real.
Looking forward, what's on the horizon?
We're witnessing indicators suggesting a significant market downturn is imminent, with historical patterns hinting it could happen sooner rather than later.
What about potential market recoveries?
There may be temporary recoveries during this period, but the longer-term outlook could still paint a troubling picture for investors.
So what key message should we take away from this?
Ultimately, the yield curve's fluctuations are sending warnings about potential economic challenges ahead. Staying informed and adaptable in investment strategies will be essential for navigating these uncertain waters.
And what should investors keep in mind moving forward?
Keep close tabs on the yield curve and broader market signals. Understanding these patterns can give investors a better edge during volatile times.
As we wrap up this segment, we want to hear from you. What do you make of the current signals in the market?
Drop your thoughts in the comments below. Your insights could be a valuable part of the ongoing conversation.
Time to navigate through the waters surrounding consumer savings. Our focus today is the alarming drop in the US savings rate, now plummeting to just 2.9%. With concerns of a recession looming, what does this mean for American households?
Let's get right to it. This troubling news underscores the difficulties consumers face in sustaining their spending amidst rising costs and stagnant incomes. There's much more to unravel here.
What's the main thesis here? Are American consumers really out of cash?
Absolutely. The core thesis centers around this alarming savings figure. With only 2.9% in savings, consumers are forced to cut back on spending, reflecting severe economic distress that could worsen without intervention.
What does this low savings rate indicate for consumers?
It signals that consumers are draining their last reserves. A savings rate this low suggests an economic crunch, where spending may significantly decline, something we cannot afford to overlook.
What's the outlook for retailers with consumers tightening their belts?
Discretionary retailers will feel the impact. With diminished cash flow, stores like Dollar General and Lululemon are setting themselves up for drastic sales declines.
How is the labor market reacting?
As individuals observe friends or family struggling to find work, their instinct is to save. I better hold on to my money. This avoidance mentality only contributes to the economic slowdown.
What are companies predicting in light of this trend?
They're sounding alarm bells, forecasting sales declines and potential layoffs ahead. Firms like Big Lots are already facing bankruptcy risks due to low consumer demand.
Looking ahead, what's the forecast for consumer spending?
Prepare for impact. Continued spending cuts appear inevitable. As consumers tighten their belts further, layoffs will likely follow, worsening the situation.
What's the broader economic implication?
The signs of economic downturn are spreading. We may be on the verge of a widespread recession impacting multiple sectors.
In summary, what's the takeaway from this grim situation?
Consumers are in a precarious position, with spending waning as savings dwindle. This scenario is a clarion call for economists and businesses alike.
So what's the bottom line for the average consumer?
If incomes don't rise and consumers can't save, we're heading for a potential downturn. So keep an eye on your wallets and necessities.
As we wrap this up, we want to hear from you. What do you think about the consumer savings crisis?
Drop your thoughts in the comments. How are you preparing for the economic tides?
Let's navigate the turbulent waters of today's discussion on Bitcoin's volatile future. What might happen if Trump secures the next election? Bitcoin's destiny could very well depend on it.
Indeed, Michael Saylor, executive chairman of MicroStrategy, has been vocal about Bitcoin's prospects. With a notable history in tech adoption, he's a compelling voice raising the alarm about cryptocurrency.
So what's the crux of this discussion? Why is Bitcoin's future so closely linked to political events?
Saylor's main argument posits that Bitcoin could skyrocket to $400,000 if Trump wins the election, reflecting broader market sentiments and the power of influential figures.
Let's break it down. What are Saylor's predictions for Bitcoin's price?
He confidently anticipates Bitcoin reaching $400,000 by the end of the upcoming cycle, with a longer-term goal of $1 million by the year 2030.
How does Bitcoin's performance compare to traditional assets?
Bitcoin is slated to grow at twice the speed of the S&P 500, positioning it as an exciting investment. It even surpasses some high-flying tech stocks.
What's the political angle influencing Bitcoin's trajectory?
The election outcome is crucial. A Trump victory could send Bitcoin prices soaring, while a defeat may spell trouble for the cryptocurrency market.
Looking ahead, what do predictions say about Bitcoin's future price?
Should Trump win, Bitcoin might hit $400,000. However, if the opposing party triumphs, those hopes could be quickly dashed.
What long-term trends might support these Bitcoin forecasts?
If global liquidity remains stable, Bitcoin could continue to soar, emerging as a robust hedge against inflation that many investors are eyeing.
In summary, what are the key points viewers should remember from this analysis?
Bitcoin's future isn't just about numbers. It's a narrative interwoven with politics, investment strategies, and the fundamental right to asset ownership.
To wrap up, what are your thoughts on Bitcoin's future as we edge closer to the elections?
We want to hear from you. How do you see Bitcoin's destiny and its relation to the political landscape? Share in the comments below.
Let's dive in. This week marks a pivotal moment for markets as essential economic data comes out that could shift the tides.
Absolutely. The forthcoming data may provide insights into whether the economy is rebounding or if we're bracing for a new storm. Let's unpack what lies ahead.
What's the essence of the upcoming data?
The gist is that this week's reports could reveal a modest improvement in the economy, though underlying indicators suggest reason for caution. It's akin to navigating through a foggy harbor.
What key economic reports should we pay attention to?
We can expect a slight increase in the manufacturing ISM PMI, hinting at a possible rebound in the manufacturing sector. However, the Jolt's report might reveal a decrease in job openings, signaling a weakening labor market.
What are the trends in the job market?
Job losses have surged significantly, challenging the notion that new entrants are solely responsible for the fluctuating unemployment rate. It's a complex landscape.
What insights does the yield curve provide?
The steepening yield curve often acts as an early warning signal for recession. Historically, it has prompted increased volatility in equity markets. Hold on to your hats.
Looking forward, what do the forecasts suggest?
Predictions indicate a drop in job openings, suggesting an economic slowdown. If wage growth continues to decline, we may be inching closer to a recession.
What should we anticipate regarding market volatility?
Prepare for turbulent waters. As data is released, volatility is likely to rise, potentially leading to a bumpy ride for traders.
To summarize, what's the essence of the insights shared?
In summary, while there may be signs of recovery, underlying pressures are prompting market participants to remain vigilant and cautious.
As we close out this segment, what's your take on this week's anticipated data?
Let us know in the comments below. Your insights could shape the conversation as we navigate the complexities of our economy.
We've just heard from several experts about the critical financial trends shaping our future.
Absolutely. Michael Saylor highlighted how political outcomes could lead to Bitcoin reaching astonishing heights.
Jeff Snider raised concerns about the declining consumer savings and its implications.
Ian Harris elaborated on the yield curve inversions, which have historically been reliable recession indicators.
Truly a mixed bag of insights, as Mark Moss reminded us about the unpredictable nature of Bitcoin's fate.
Thanks for joining us today. Keep an eye on these financial indicators and stay tuned to
Remember to like and subscribe. Thanks for watching Financial Insights in Minutes for September 2nd, 2024. If you found this time-saving content useful and want to support the channel, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.